Do you think we're going to see oil not go that high, or do you think we're going to see oil skyrocket pretty soon?
Well, Alexander, first of all, gasoline in constant dollars, which is to say in gold terms, is cheap.
Yeah.
Gasoline is not high. The dollar is low. It's important to note that. In your state, the People's Republic of California, the reason that the gasoline price is high has nothing to do with the oil price. It has everything to do with Governor Newsom uh, taxing the oil industry as much as he can into oblivion. His politics is more important than your economics.
Yeah.
Get that straight. Now that the political lecture's done, let's review the question. I love the oil business. It is a hated business and it's a great business. I've invested in oil and gas for 20 years. Pardon me, 50 years. Time flies when you're having fun. And I would suggest that the current climate for investing in oil and gas equities is as good as I have seen in 50 years for the following reasons. Natural resource-based businesses are cyclical and volatile. The cure for low prices, Alexander, is always low prices. So low price environments for oil and gas begat demand and hence higher prices. Better than that, oil is hated. An investment class that at least bores people, or better yet, hates people, is always a superior asset class because it's cheaper. You're competing with less bidders. And oil and gas is misunderstood in at least three ways. The first is, and it's very popular in your home state, that oil and gas is going to be replaced by sources of alternative energy, things like wind and solar. The truth is that depending on the source that you cite, humanity has spent between 6 and 11 trillion dollars, trillion, over the last 45 years on alternative energy. And we've reduced the market share of carbon as an energy source from a high of 83% 45 years ago, all the way down to 81% today. A $6 trillion investment has reduced carbon's market share by 2%.
Yeah.
The big thinkers in the world, Greta Thunberg, Angela Merkel, Justin Trudeau, Governor Newsom, would suggest to you that peak oil demand occurs in 2030, which is hokum. Peak oil demand occurs in 2060 or 2065. And what that means is that when analysts are discounting free cash flows and the net present value of oil producers, what they're doing is they're ending the value curve in 2030 or 2032 and forgetting the tail on net present value, which is where half of the value in these companies are. That suggests that if you take the public oil companies on aggregate, they are undervalued in the market by 50%.
Mm.
And that ignores another critical fact. Depending again on the source that you cite, the oil companies in aggregate, including the state-owned firms, are underinvesting in sustaining capital to the extent of between $1 billion and $2 billion a day. Never mind underinvesting in new project capital by about 80% of their historic levels. This is a capital-intensive business. And if you don't reinvest in your business, you impair, sometimes permanently, your ability to produce. It is my belief that the chickens come home to roost with regards to these sustaining capital impairments within the 3-year time frame, which is to say, I believe that the nominal price of oil goes from its current $55 level to $85 or $90 within 3 years. The opportunity then is that if you can find a company that's priced at a substantial discount to its net present value at $55 oil, and the margins triple as a consequence of the price clearing from 55 to 90, what you've done is you've bought yourself a triple at a discount to net present value currently. A wonderful, wonderful opportunity.